here, and we are on the live edition, the Syndication Live, and we have Clay Rockwood with us. Clay, man, I'm so happy to have you here. It's been fun to getting to know you more. I mean, I feel like we've been in the same circles for a long time and know a lot of the same people, but lately, with some of the content we're creating, I'm really understanding your business and the things that you've done, and it's pretty amazing story. So I know we don't want to, take this whole time to talk about your story, but it is important for people to know who you are and what you've done in real estate. So Clay, let me just turn it over to you for a second to share a little bit about yourself.
Awesome. Well, thanks, Christian. Yeah, and again, it's a pleasure to be here. Thank you so much. Honestly, I love what you guys are doing with iShare. So super excited about what's to come. But yeah, so a little bit about me. I mean, I got my start in real estate back in 2008. Right at the worst time as the market was crashing, and was kind of a really opportunistic time, honestly, to learn the business, to kind of figure out my footing and see where I wanted to land within real estate, because there's so many different niches you can do in this business. And so, honestly, I started as a realtor, right, representing clients. I soon realized I didn't have a passion for that. I really wanted something that gave me freedom of time and kind of be my own boss. I was always an entrepreneur at heart. So did that for a couple of years. And then, after that, started flipping some homes. My brother is a contractor. My dad does architect stuff. So we kind of formed a partnership, started flipping homes. And again, flipping homes is great when the market's great, as we've seen now in the downturn. It's gotten crushed, right? So even then, the flipping business can be good. It can be very volatile, very up and down, very time intensive. So I can't say I don't like flipping homes, but we're definitely moving away from that. We still do a handful, but really what I started doing back then in 09 and 10 was I wanted to buy rentals, right? Our first property my wife and I owned was a triplex. We lived in one of the units, kind of house hacked and rented out the other two units. So that's really when it kind of clicked for me and instilled in me that fire and the passion to like build a rental portfolio. And again, at the time, I just kind of had a small goal of, buying a property a year, whether that was a duplex, a fourplex. And that was great, right? And we kind of did that for several years. But fast forward, 5, 6, 7, 8 years, we had a small portfolio. I mean, again, very small. I think we had 12 doors or something in a space of 8 years that we bought. And then I started realizing like, hey, man, there's so much more out there. I'm capable of more. And if I just utilize and leverage other people or have a team, I kind of realized I was a bottleneck. So since, 2017, since then, we've kind of really ramped up our acquisitions, and now we own over 400 doors, multifamily and mobile home parks. We have a team in place, partnerships. So yeah, it's kind of been a fun journey to start where I started, to learn and have gone through all these different niches. We've done wholesaling. We ran a large scale wholesaling operation, wholesaling 100 plus homes a year. I've done short sales, foreclosures, realtor. Like I've kind of run the gamut of this, and honestly, where I've landed and what I'm really passionate about now is just larger deals, right? Larger multifamily, mobile home parks, because there's just an economy of scale, and honestly, less brain damage, to be honest. And we can talk a little bit about that. But yeah, that's kind of where we've landed now. It's just we're out hustling, buying larger deals. We're under contract on, over 300, I think over 400 doors right now. So we're really ramping up.
Man, that's great. You're looking to double your portfolio in not a lot of time. So
yeah.
One thing I love about your story, and I think we use it a lot on, when we're sharing about you and we had you on the show with the Syndication show, and we did that interview, and you talked about this isn't get rich quick, it's get rich slow. And it's still faster than pretty much anything out there. But I love your approach to it, to where personally, if I could go back, I think house hack is the best way to get started in real estate. You can do it really young. You can step your way in and you can start building equity. And then from that, to have that idea, I actually have a friend of mine who is a CPA and attorney, Mark Kohler, and he always talks about that. If you could get the school teacher to just buy one property a year, by the time that it was retirement, they would be multimillionaires.
Yeah.
And so that's kind of how you built your way up. And then because you did that, you continue to learn the process, the game, the business, the different aspects. And I think wholesaling, when you took that on, that probably gave you the opportunity to see the inside of a lot of different types of deals as well, even if you weren't doing those deals, right?
Mm-hmm. Yep.
So you've got a great approach, and it looks like you're on a huge upward trajectory. So I'm glad that we're going to have a chance to work together in a few different ways, and just continue to see you grow, man. That's awesome.
Likewise. Thank you.
So when it comes to the deals that you're doing now, let's talk about those for a minute. And I think I've got Brendan on here. I'm going to have him put into the chat the interview that we did with you. And that way, if people are watching this, whether you're watching it live or you're watching this recording, put that in the comments, by the way, and then jump over and watch the longer episode, because that was a lot of fun. And there's a lot of great insights in that. But Clay, talk to us about the deals that you're under contract on now. 400 doors. Is that 4 different properties? Is that 2 different properties? And what do they look like?
Yeah, great question. So it's a mix of multifamily and mobile home parks. So those are the 2 kind of asset classes that we do now. So one of them is it's actually a portfolio of mobile home parks. It's 5 different mobile home parks, kind of within a 2-hour radius of each other, back in the Midwest. So again, we're sourcing a lot of these off-market, direct to seller, or through kind of our broker relationships. So we're able to get these for really deep discounts and good opportunities. We typically target kind of the type of property we do, just from our experience, is heavy value add, right? So properties that they're dilapidated, maybe run down, need a lot of work, or poorly managed. Maybe it's got a tired landlord that's owned it for 30 years and is just ready, to retire. So those are the types of assets we target, kind of in the Class B, Class C type properties. And we've just had a lot of success with those, just kind of right in our wheelhouse. But yeah, I mean, that's the kind of assets we're targeting right now. And kind of what I've learned over time, when you're getting into, I guess, the space we're in, when you're talking about syndications or maybe larger deals, I think the hang up that a lot of maybe newer investors or people that want to maybe go from that, hey, I've bought a duplex, or maybe I own a couple single family homes, or maybe I bought my first rental, and now I want to scale to larger deals. How do I even do that? Right? That's a question I get so often. It's like, where do I even start? Like, what are the numbers? How do it just feels like daunting to them. And obviously some of that just comes with time and experience. But I honestly think now that I've done it can be a lot simpler than most people think. If you just learn some of the basic terminology, some of the basic numbers, and then from there, you can really leverage, the experience of other people to kind of help you along the way.
Yeah. I agree with you. And it's sometimes just getting the lingo down, right? And understanding what you're learning. Because you go to an event, for example, and people are throwing around all of these acronyms. And I'll tell a funny story that's a little embarrassing for me. But when I was first getting into real estate, I was like 20, 21 years old. And I started going to these conferences. I was getting involved with this real estate group. And they were always talking about subject to. And for the longest time, it was like months that I was like, I wonder what subject number 1 is, And it wasn't until somebody went up there and they broke down subject to and actually said, like, it's subject to the existing mortgage staying in place, that it like clicked for me. So I think that's super helpful. While we're on the topic, maybe throw some of those out. Like, what are the key metrics that you're looking at this stage in your business? And what does that mean for somebody who is brand new, maybe seeing this?
Yeah, that's a great question. So I think, some of the basic things that are important to understand are, the first thing would be how do you underwrite a deal, or how do you know what numbers are important, right? So on a very basic level, whether that's a single family home or a 100 unit apartment complex, really the process is the same. You want to look at what are the potential rents, right? Or what is the potential income of that property? Well, how do you know that? Again, you can study that. You can go to YouTube, but really, like, what we do is we leverage a good property manager, right? So, I mean, you can Google it right now in your local city or state, wherever you are. A great property manager, call them up, say, hey, I'm looking at purchasing XYZ property. And what do you think a 2-bedroom, 1-bath apartment would rent for? Yeah. So again, I'm just kind of walking through what I would do if I were just trying to get some basic information. Is, again, leverage a property manager that can kind of help you run some of those upfront numbers of, okay, what could the income be? Now, once you have that, okay, let's say on this property, it's going to gross, $500,000 a year or whatever, between the rents and all that kind of stuff. You talk to the what kind of vacancy we're going to have, and you kind of deduct that out. And then you want to think about expenses. I use just a general rule of thumb to make it simple. On larger scale multifamily properties, we underwrite anywhere from a 45% to a 55% expense ratio. Again, that's going to vary depending on if you're self-managing or the different market it's in. But I've found that's just a very good blanket ballpark range that's safe. That'll put you safe. So I'd say 50%. So if you're bringing in $500,000 a year in revenue, in gross revenue, take half of that, and that's going to be gone towards expenses, property management, maintenance, reserves, utilities, all that kind of stuff, right? So once you have that, you really have your, and taxes and insurance, things like that. Then you have your net operating income. That's another, the NOI. That's a term that is thrown out there a lot, and you really need to know that. But once you've found your NOI, your net operating income, then you kind of know, okay, what can I do with this? I know how much it's going to net me. Then you can talk to a mortgage broker and say, how much would a loan be on this? What would my monthly payment be? And what would my down payment require? So again, once you just understand that basic structure, revenue, expenses, NOI, then you can start kind of figure out what kind of debt you can get. Obviously, you can start figuring out the cap rate, which is how, commercial properties are valued. And again, do a quick Google search on cap rates, or talk to a local mortgage or a local broker that can kind of run through you and say, oh, okay, cap rates in this market are 5%, or cap rates are at 6%. And that's directly correlated with the net operating income. So I know I kind of threw out a lot of things there, but really in a matter of a day, just by kind of focusing and honing in on some of these numbers and maybe researching a little bit, talking to a few people in your local market, you should be able to have a really good basic understanding of how to evaluate a property, and whether it's a good deal or whether it's going to be upside down cash flow wise, and what price you need to pick it up for.
Yeah, and some key things that I took from the things that you said, because I use the same way, even as a very beginning investor. When I wanted to know rents, I would go to the online sources that you could do a quick, analysis. And then if it looked basically good, then I would start calling those property managers, and they're financially incentivized to give you that information because their hope is that you'll use them. And so obviously, if they do good at sharing that information, you may end up using them. And that's kind of the idea there. But if you call 2 or 3, you can average all of those numbers out. Take the online numbers, take the property manager numbers, and then kind of average it out, and also decide which one you trust more, right? There's different sources of information that you're going to trust at a higher value. And then come up with a basic formula, because that's going to get you, unfortunately, a lot of people, they spend a lot of time going to look at properties that don't even come close to fitting into their box, right?
Yeah.
And so you got to get good at just quickly analyzing numbers. And that's where I think formulas are important. One thing that I always add in, and I'm open to debate on this with you, but you might have the same idea, is a formula is always a starting point, but you have to run the real numbers. You have to actually get into the nitty gritty. And when you are coming down to buying a property, and this is where, same thing, I've been around the real estate investing training world for so long. I've seen a lot of people get started in the business, succeed in the business, not succeed in the business. Mm-hmm. And oftentimes people take a formula that they hear, and then they're like going to the closing table without fully analyzing the property. Yeah. And if I'm lucky, if they're lucky, then we catch them in time, and we say, wait, let's make sure we do the proper analysis.
Yeah.
But would you agree with me there that you're getting the formula so you can get close, so you know whether it's even worth looking at, but ultimately you've got to run every single number and do your full due diligence.
Totally. Yeah, no, and I totally agree with that. In fact, here's a great example of what you're talking about. We were just under contract on a 174 unit multifamily deal in San Antonio. And I mean, honestly, it took us 6 months. We've really been working on this deal for 6 months, and we finally just this week said no, and we passed on the deal. So backing up, why does that take so long, and what happened there? So I think, like you're saying, I think you need to have different stages, right? So stage 1 would be the quick analysis, the quick sniff test, right? Like run those quick numbers like we just talked about, put it in maybe your calculator, your spreadsheet. Again, you can make it as simple as you want. And if it passes that first, just, okay, the numbers seem to make sense here as a general rule, then you would kind of move to the next stage, right? So but I would recommend people don't get caught in this analysis paralysis or this analysis funnel where they're literally putting in every dollar and cent before they even have the property under contract, before they've even negotiated on it, before they've even done anything. They're kind of running all those little teeny numbers. It's like, well, wait, just look at it from a broad perspective. If this even makes sense, if it does, then you can start diving deeper. And that's kind of what we did on this property that we were under contract on. Obviously, it's a larger asset, but we put it in our underwriting, and at first glance, it's like, okay, this makes sense. Well, then once we're under contract and we have a due diligence period, a period of time where we know whether we can move forward or back out and still keep our earnest money, then we start doing that deep dive, right? We visit the property, we talk to property managers, we start looking at vacancies, we look at the economics of the market. What does this match up, or is this not right? We run the pro forma on a deeper level. And then it kind of starts, the layers of the onion start revealing itself in a way. So that would be my recommendation, though. Yeah, you're completely right. But I think that alone, that thought of trying to do these deep dives for every single deal that hits the market every day, it's like you're going to get bogged down. You're never going to do anything.
Yeah. Right. And this is where I feel I see a lot of people get frustrated, is because, they'll come to me and they'll say, is this a deal? And I don't know. Is it a deal? What do you mean? What kind of deal? What does that mean? Right.
Yeah.
And then they want to get into all the nitty gritty, and it's kind of like you have to know enough. And it's almost like sifting, right? You're sifting for the gold. So you take the really big, picture, and if it makes it through, then you start sifting that down. And if it makes it through there, and ultimately you get to the point where you feel comfortable spending money on real due diligence, because when you get into real due diligence, you're going to be paying professionals to get out there. You're going to be paying for reports. And ultimately, and it sounds like you just had this on a fairly large deal, you probably spent some money in that 6 months to walk away from it, right?
Totally. Yeah. Tens of thousands of dollars. But that's the thing you learn over time. And it was hard for me initially, but I think so many people get caught up in this idea of I just need a deal, or I want a deal because I want to do a deal. Yeah. Well, that's great and all, but I mean, you have to get in the mindset of saying no 99 times and saying yes once, right? That's really what it is. And you have to just be comfortable just walking away and be like, nope, this is not a deal. And I'm going to be patient enough to where I can buy a deal. In fact, one of my friends in one of my masterminds, he only buys one, maybe two large deals a year. Like he just a couple of years ago, he bought 1,000 unit apartment complex, and that was the only deal he bought that entire 2 years. So, you could look at that and be like, well, he could go out and do 20 more deals. Well, maybe, but they may be 20 mediocre deals, or deals that are going to take his headspace away, when he could have focused just his time and effort on, I'm going to go find a good deal that's a big size, and I'm going to focus all my energy on that. Right. So I think you can get so shiny object in this business. Like you said, someone brings you a deal, some wholesaler brings you this property. Hey man, take a look at this. Let me know your thoughts. Okay. Well, that sucks 2 days of my time to just run numbers for this guy. It's not even a deal. Yeah. Right. So I think you just have to be careful of where your focus is, know what your numbers are, know what metrics you want to meet and returns you're trying to achieve. And that's something you just have to determine for yourself.
Yeah. I always tell people, don't be too quick to lose money. And in this business, the most money you're going to make is the money you save by not doing bad deals, because there's 100 bad deals to every one good deal. And if you take on even 1 or 2 of those bad deals, you're going to be, pretty far in the hole. And if you have the headspace to bounce back, you're then starting from zero again.
Yeah, exactly.
So when you're running a multifamily unit versus mobile home parks, what are the different things that you're looking at, and what are the different risk factors? I mean, it sounds like they might be similar in looking at B and C class properties. Sure that there's different factors that come up that you have to look deeper in. I'd love for you to share some of that.
Yeah, definitely. That's a good question. So with multifamily, it's a very, I would say it's more straightforward, honestly. Again, for a newer investor, it may still sound complicated and tricky to understand how to underwrite those deals, but honestly, it's a lot more clean and simple. As far as how a bank will, what kind of debt you can get, how they underwrite it, talking to a mortgage broker, they can tell you that in 10 minutes. On the mobile home side, some things that are important to look at are how many of the homes in that park are park owned homes, meaning they're, the owner of the park owns the actual house and is just renting it out to a tenant, versus tenant owned homes, right? The tenant actually owns the mobile home and they're just paying a lot rent. Because again, when it comes down to your debt, your financing from a bank or a credit union, that's important, because typically banks or credit unions, they will not lend on park owned home income for whatever reason. They just don't like it. They don't like a unit that's owned by the park and is rented to a tenant. They prefer lot rent. So they'll typically only lend you money based on what lot rent you're collecting. So like, for example, this one of the deals we're under contract on, it's half occupied by tenants, lot owned, and then half owned by park owned homes, which is a big deal. And so we when we run our numbers and we make our offer, it's based on, hey, we can only count the income here from the lot, the lot rents, not whatever income you're getting. So there's just some distinctions like that you kind of have to know when you're in these different asset classes, whether that's, multifamily, mobile home, retail, office, where, there's every niche has its own little thing. So the financing is a big one for mobile home parks. But the reason I think the other distinction why we like mobile home parks is, especially in today's climate where, over the last 10 years, we've seen insane rent growth. We've seen insane property value growth. It's still an affordable housing option for the majority of the country. And it's a dying asset, right? Most municipalities, counties, cities, they don't allow any more mobile home parks to be built. So it's kind of this asset that you can't build anymore, but it's still an affordable housing option for a lot of residents, and they like that. And so we see that typically returns are slightly better in the mobile home park industry. It's an asset that's, I would say, not on the forefront of most investors' minds, because again, it kind of has a stigma of trailer trash, or, oh, this is a rundown, trailer park. It's not as appealing or sexy as this nice big multifamily complex. It looks pretty, but honestly, the returns are so good. They're more stable. Cash flow is a lot higher. And we really feel like it's an asset that's, recession resistant in a way, because again, if you've got a class A, let's say, multifamily property in the recession, you're probably going to have some tenants that are going to be moving out of that high ticket rent, for an apartment, and moving into lower income housing and things like that. So anyway, there's a lot of reasons we like, but that's one metric that is really important to look at. And there's a few others, but it kind of helps to just, again, utilize someone that's done mobile homes and kind of understands the industry a little bit to tap into their knowledge base.
Yeah, that makes so much sense, because obviously there's value in having those homes, and you could potentially sell them with seller financing and,
Exactly.
add some additional revenue streams. But you have to know what the bank will give you ultimately, especially if you have an exit strategy that includes either a refinance or a purchase through the bank, right?
Exactly. Yep. Yeah, and different things. Again, you can get really deep into it, but like, are they on septic systems? Are they on city water? Does the city maintain the roads? There's just kind of all these checklists you have to go through. And so I think the barrier of entry to buy mobile homes may be a little harder to just kind of understand. But again, once you understand the basic terminology or what things you need to ask, then it kind of opens up that world and becomes less scary.
That makes sense. So I know you're doing a lot of syndications now, but there's a lot of different structures. So what does your typical structure look like? Are you bringing in all the money because you're doing a huge value add, or are you still using bank financing on the front end as well as the back end? Give us kind of the scoop there.
Yeah, great question. So how we structure most of our deals, again, most of our deals are value add. So we're putting in significant amount of work or money to upgrade the property. So typically what we'll do is, we'll get a bank loan, right, for the portion of the purchase price. So nowadays, again, it's anywhere from 60 to 70% LTV, loan to value. Historically, that was higher. You could borrow 75 up to 80%. We've just seen it's a little lower. So how we structure our debt, that's one thing I want to mention is, especially now in this climate in the market, we always lock in long-term fixed rate debt. That's important in the commercial world, right? There's so many different loan options out there, more so than there are in the single family or residential space. you've got floater debt, you've got adjustable rate mortgages, you've got bridge loans that are short 2-3 year loans, right? Well, those are high risk because the volatility and the interest rates and things like that. So nowadays we're just locking in fixed rate debt for 5 to 7 year minimums. So, hey, this debt's not going to change. We know what our payment's going to be regardless of what the interest rates do over time, which is great, because even if the market continues to decline, we're kind of hedging against that bet and, just securing debt, right? So the debt structure is one, but aside from that, how we structure our deals is we typically, like a lot of syndications, we offer a preferred return to investors, meaning an annualized kind of return that they get before we get paid anything. That's typically 8% is what we do. And then we'll have an equity split anywhere from 70%, 70-30 split, to the investor, 70%, 30% to us, or 80-20. It just depends on the deal. But really the metric we're trying to achieve when we're figuring out that deal structure is the return to the investor, or the internal rate of return, the IRR that we say, right? And that's a metric you'll see a lot, the IRR and then the equity multiple. Our metric that we use internally is we want to achieve at least a 20% IRR for our investors. And again, we're throwing out some terminology here that may be confusing, but again, these are just some simple things that I think it's important for people to learn and understand. An industry standard, like if you're going to go look at any other syndication, any other investment opportunity in this space, you're probably going to see IRRs estimated anywhere from 13, 15%, maybe up to mid 20s. But that's why we feel that 20%, if we can find a property that achieves that, we know that we'll be able to raise the funds. It's a good investment for our investors, and we'll, usually have success on that type of property. And then last thing would be the equity multiple. Again, I won't get into the specifics of the equity multiple. It's basically just you invest $100K, and if it's a 2x multiple, you should double your money in that investment for the however long you hold it, right? So our equity multiple threshold is anywhere from a 1.6 to obviously 2x plus is what we're targeting for investors. So we want them to double their money during that investment period, and we typically have a 3 to 5 year hold on most of our properties. We'll buy it, fix it up, stabilize it, and then either sell it in those 3 to 5 years or refinance, cash out a bunch of the investors' money, and then just long-term cash flow.
Got it. That makes sense. And by the way, for those of you guys that are watching, if you want more details on some of these terms that he's throwing out, go to the Pre-iShare community. So the Pre-iShare Facebook group community. We're going to be adding a lot more in there to just add value to folks. There is an accredited only group as well, but that one's more new. So just go to the general community. Brennan just put it in the chat, and let us know what are the topics that you would want us to break down for you. And now, Clay, obviously people want to invest in real estate because of these factors. You're giving them an 8% return, plus they have all of the potential upside. Both going along and on the back end. What is the typical threshold that somebody needs to meet to be able to invest into one of your deals?
Great question. So most of our deals, we only accept accredited investors, right? So someone that meets that status, makes a certain amount per year and has over $1 million of net worth. So if you're an accredited investor, we can accept funds from those people. But really our minimum investment is typically $50,000. So we try to make it an approachable amount for most people. If we have a minimum of 100 or 200K, that kind of eliminates a lot of people. But yeah, we accept a minimum of 50,000 from any accredited investor. And we really, this is kind of a side note, but part of our goal with our investors is to really make them feel, obviously this is a passive investment for them, a truly passive investment, right? They put their money up and they don't have to ever think about it. They just collect that check every quarter and that's it. But we really want that investor to feel part of the deal. We want them to have pride in this asset, right? Like, hey, I invested in this deal. I own a portion of these, this multifamily complex. And so part of our process internally is just, we really involve the investor on a kind of a monthly basis with monthly updates and photos of how the renovation's going and videos. Hey, here's what's happening now on the property, and we found that the investors really like that. I've talked to a lot of investors that have invested in other syndications or other businesses, things like that. And they're like, I put my money up and then I haven't heard from someone for a year. Like I have to go hound down my tax documents. I have to email them for what's going on, So I feel like there's room in this space to do a lot better with investor relations and making sure investors know what's happening and they stay involved in the process.
And that is one thing that we are striving for with pre-iShare, is to open up those conversations that may not be being had.
Yeah.
You have oftentimes there's syndicators out there that they're so focused on the next deal, they're not even considering what their previous investors are feeling. But if we could help them see this conversation and understand that those investors do want to be more involved, and they may not have the time to be an active investor to run their own deals, but if they could have that pride, like you said, kind of that pride of ownership of having a portion of that deal, it's more likely that they're going to want to continue to invest with you moving forward. I would dare say, even if they're getting the same return as somebody who doesn't follow up with them, if they feel more connected to the project, then they're probably going to want to stay in it more.
Definitely. I totally agree. Yeah.
Well, Clay, how do people get a hold of you if they want to be more connected, they want to see more about what you're doing, or even potentially invest in your deals? What's the best ways for them to do that?
Yeah. So, the first thing would be just go to our website. So it's soarcapitalgroup.com. We can put that in the chat, but yeah, just SOAR, soarcapitalgroup.com. And right within there, you can kind of see about us, our portfolio, what we've done, our history. And then right within there, they can be added to our investor club. We kind of give our investors first access to our upcoming deal that are part of our investors club. It's so they can just sign up right there. It's free. There's no cost or anything. But yeah, if they want to learn more, our website, and obviously I put out a lot of content on social media. That's just my name at Clay Rockwood on Instagram, Facebook, my YouTube channel. Again, I'm trying to provide as much value as I can, educate people, help them learn this business. That's the most common question I get from people is just, how do I get started? I want to do what you're doing. How do I start? Where do I start? And again, I just, because I didn't really have that when I was starting, that's my goal. Is I want to help people get a jump start, right?
Yeah.
I want to help them learn just, again, the basic terminology, or where to start. What's the first step, or how can you get involved in these larger deals? So anyway, that's where they can find me. Yeah,
that makes sense. I remember first getting started in real estate, and some of the best ways that I learned was I just watched other deals happen. Even if I didn't know the person, I'm like, I think that's a good deal. I'm just going to watch it, and I'm going to go back and see it when they list it again, and I'm going to estimate in my mind what I thought they did, and how much they may have spent. But it's a lot better to be involved with guys like you, with like the pre-iShare. If you go to our YouTube channel, we're gonna be doing more on-sites where we go out with syndicators and talk about their deals and the numbers that they're breaking down and why they chose to do the deal versus pass on it. And there's so much that you can learn by paying attention to people who are in the game. But then ultimately, you got to get in the game, right?
Yeah.
So Clay, leave people with some solid advice as we end this thing. What is that determining factor that's going to help push them over the edge and get them in the game?
It's a good question. And my answer may be a little unconventional. I don't know. But I talk a lot about the mindset of belief. I've shared this experience where even now, whatever hurdle I'm facing, or whatever fear I may be feeling, or insecurity of like, I don't know if I can do this, I'm not smart enough, whatever, right? To me, that's the biggest roadblock of anything. Like, before we even get into like learning the lingo, learning the numbers, learning how to do this, how to find a deal, it's just the belief that you actually can achieve it. So I sometimes I'll be in my car and I'll just sit there and yell to myself, I can do this for 10 minutes straight. I can do this. So the mindset is big, but then aside from that, it's just taking some sort of action, right? I've found that action is the eliminator of fear. Whatever fear you're facing, if you take some level of action, that fear will be eliminated, because we build up in our heads this story that's much worse than the reality, right? So even, and I would just say this, like, reach out to someone like me or you, tap into some resources and just put down your ego. I think so many people get in this space wanting to be the expert from day one, and they don't want to come off as like, I don't know, like your subject to story. I don't know what subject to means. I'm not going to ask someone. I don't want to be the idiot in the room. Well, I promise people in this space that we're here to help. Why do you think we're putting out this content? We're trying to help you, right? Yeah. So approach people and say, hey, I don't know what I'm doing. Like, I want to learn this. I want to add some sort of value, but I don't understand this. Can you help me? So, letting your ego down, asking for help, so those three things, yelling in your car, believing in yourself, and then just taking some sort of imperfect action. You're never going to know it all. You're never going to have all the answers. I don't. I'm always learning every day, but you just have to move forward one step at a time every day.
Yeah, makes so much sense. And I tell people this all the time. You have such an advantage when you're a newbie because you can ask all the dumb questions and nobody cares. Nobody is judging you. It's, you get to a certain level and and you start having some of these like, man, I got to talk to somebody still and get these questions answered. So when you're brand new, live it up, right? Go ask all the questions.
Be hungry and just gobble it up and just go out there and get it. Yeah.
Yeah, I love it. Well, Clay, I look forward to seeing you and connecting with you more. Appreciate you being on here, and we'll just leave it at that.
Thank you, Christian. Appreciate